Hi guys, Sandy Ingram here. Welcome. How is Iraq or any other country's exchange rate determined? And how does trade fit into the picture? We already know that there are 7 basic factors that help determine any country's currency rate, including the United States and the UK. The 7 basic factors are inflation, interest rates, political stability, balance of payments, national debt, recession, and terms of trade. In today's video, we will explore the world of exchange rates and trade. Exchange rates, in their most basic form, represent the value of one country's currency in relation to another's. Picture this. You're in a marketplace. The price of apples fluctuates based on supply and demand. In the same vein, exchange rates fluctuate based on the demand for a country's currency. Now, what factors can affect this demand, you ask? Well, there are quite a few. Economic performance, political stability, interest rates, inflation, and speculation, to name just a few. For instance, a country with a robust economy and political stability will likely have a strong currency because people trust it. They want to invest in it. They want to hold on to it. But the moment something goes wrong, a political upheaval or an economic downturn, people might start selling off the currency, and the currency rates it drops. Interest rates and inflation also plays important roles. When a country's interest rates are high, it attracts foreign investors, which increases demand for that country's currency and pushes up the exchange rate. Similarly, low inflation can make a country's goods and services more attractive to foreigners, which can also increase demand for its currency. Speculation, on the other hand, can cause exchange rates to change rapidly. If traders believe a currency's value will rise in the future, they'll buy more of it, increasing its demand and pushing up its exchange rate. So, where does trade fit into all of this? Trade affects exchange rates through its impact on the balance of payments, that is, the record of all economic transactions between the residents of a country and the rest of the world in a given period. When a country exports more than it imports, it has a trade surplus. This can increase demand for its currency and push up its exchange rate. Conversely, a trade deficit, when a country imports more than it exports, can decrease demand for its currency and lower its exchange rate. Now, let's talk about Iraq. The country's trade is heavily reliant on oil exports, which make up a significant portion of its gross domestic product. According to the Central Bank of Iraq, the CBI, Iraq recorded a trade surplus of $16.7 million in the third quarter of 2023. The balance of trade averaged $8.6 million from 1988 until 2023. However, political instability and economic challenges have led to fluctuations in the value of the Iraqi dinar. In conclusion, exchange rates are determined by a complex interplay of factors, from economic performance and political stability to interest rates, inflation, and speculation. Trade plays an important role in this process, influencing exchange rates through its impact on the balance of payments. Understanding these dynamics can provide valuable insights into the global economy and the economic prospects of individual countries, such as Iraq. So, the next time you look at an exchange rate, remember, it's not just a number. It's a reflection of a country's economic health and its standing in the global marketplace.